For equities, we've been in a bull market now for about nine or 10 months. And almost every month we've had a positive finish to the month, meaning we've ended in positive territory for that month. And a lot of markets are near or at all-time highs. The UK FTSE 100 reached its highest level since 2000 recently and is quite near the all-time high. And in terms of other big markets like the US and Germany, they are at all-time highs. And this has confused a lot of commentators because at the same time, we've had weak economies, downgrades to economic growth on a global basis, and particularly in Europe. And also we've had disappointing earnings from companies with several profit warnings. And usually there's a correlation between the direction markets are going and the direction economies are going and how companies are doing. And yet what we've seen is divergence in recent months, and that needs explaining. So the rise in markets has really been accounted for by an expansion in the valuation of these shares, which is another worry for investors. So typically companies are rated according to the price earnings multiple, and the price earnings multiple of most markets has gone up about 30% in the last 9 months or so, which is concerning obviously. So what's driving this? And I think there's two main things. One is policymakers and what they're doing in terms of central bank policy in particular. So what you're seeing is that in an effort to regenerate economies, central banks are pumping lots of money and liquidity into markets. It's meant to go into the broader economy, but most of it's finding its way into asset markets, which is helping to push up assets. And the other thing is yield hunting, a scramble for yield, because what you're seeing is compression of yields right across asset classes, in particular fixed income, with government bond yields and corporate bond yields declining substantially. In the case of government bond yields, they're at all-time lows, which from a relative point of view makes equities look quite attractive. So the shares which have done best in equities are not what you traditionally expect in a bull market, which is usually commodity shares and cyclicals, but it's more companies with higher yields, such as defensive shares in sectors like telecoms, utilities, consumer staples, which have predictable earnings. So companies such as Unilever, Nestle, Coca-Cola, those sort of companies, good brand names as well. So the question investors have to ask themselves, how long is this going to be going on for? Because the market's got a substantial amount of momentum at the moment, and there are worries that it's forming a bubble. And in my view, that markets are due for a correction, but that's not to say that it won't go higher, because other asset classes have even more of a bubble than equities at the moment, which is forcing money into equities. And also the rally has been quite cautious. And what I mean by that is that the companies which have done best within the market are quite defensive in their nature. They've come from relatively low valuations as well, and they're supported by strong balance sheets, good earnings, and rising dividends, which is extremely important in the current investment environment. For governance and monitoring any change in direction in the underlying portfolio, it's very important to take account of risk as well as return. Investment is all about monitoring risk as well as return, and it really ought to be done on an ongoing basis. So if you're a serious investor, you ought to model your portfolio, put it on a spreadsheet and keep a track of what's going on. If you're a big institution, you're going to have a spread of assets between not just equities, but you're probably going to have exposure to commodities. You'll certainly have exposure to fixed income. That would be both corporate bonds and government bonds, and maybe more esoteric investments as well. And the challenge for the institution is to find the right mix of those investments in the current environment. But also, you have to combine that with trying to monitor the risk. So to give you a recent example where the risk parameters have changed substantially recently, it's in Japanese government bonds. The Japanese government, which was elected last December, has recently implemented a new economic policy under the new Prime Minister, which is much more aggressive in its intent by expanding the size of the balance sheet aggressively, but also fiscal expansion as well. And it's had a result of making Japanese government bonds very volatile, whereas they used to be quite safe haven assets and very stable. And from that point of view, they're much less attractive as an investment, because you don't know which direction they're going to move into. They're moving up and down much faster, and you can measure that volatility and therefore put it into a spreadsheet with the expected return as well, to try to get the right mix of assets. And you should really be doing that across the portfolio. So even within an asset class, you will want to monitor which regions you've got exposure to. You want to monitor which sectors you've got exposure, what type of stocks. Are they yield stocks? Are they growth stocks? How fast are they growing the earnings, and what are the other risks involved? So it's an ongoing process. You ought to have a regular overall review of the portfolio, I think at least once a quarter, and a big review obviously at the end of each year. But from the point of view of actually finding the right mix of assets and also changing that mix and changing it within the asset class, you need to be doing it all the time, but having a major review at least once a quarter. Charity trustees, in terms of what they should consider to invest into and how they should consider how their portfolio is doing, obviously depends on the objectives of that portfolio. So are they risk averse, or do they want to take a higher risk in terms of the market? Would reflect the type of asset they're invested into. So pension funds obviously would be typically quite risk averse, and they have to match the liabilities of that pension fund, which means that inevitably they're going to have quite large exposures to bonds, and especially government bonds. And one of the problems for pension funds at the moment is that the yield on bonds has come down so much. It makes it very difficult for people who are retiring, because the annuity rates for those pensions will be extremely low. So typically at the moment you're getting about a 3% annuity rate. So if you've invested £100,000 in a self-invested pension, that means you're just going to get about an annual income of £3,000 a year, which doesn't seem very good value after you've spent your whole career building up a personal pension. So I think trustees ought to look beyond that and try to maximise yields elsewhere where yields are more attractive, because it's quite likely that government bond yields will remain low for some time, given the levels of debt in the economy and the prospects for economic growth. And this is where we come back to equities, because equities are able to grow their dividends and also have, in general, superior yields to government bonds, which is an unusual phenomenon in the last half a century or so. So for trustees, take into account the risk of the portfolio and the members of the pension fund, but also try to maximise the return given the very unusual financial circumstances we've got at the moment. Well, I think the dominant theme for investors over the next 6 months or so will be the search for a good return in a lower yield and low interest rate environment. And all the time interest rates and yields are going down. Only last month the ECB lowered its rate once again, and this follows other central banks lowering their rates, and interest rates can't go much lower, and that's been reflected in government bond yields and corporate bond yields as well. And this is one of the things which is really driving equity markets, and in particular higher dividend stocks within equity markets, because they tend to have higher yields than government bonds and corporate bonds, although there is obviously a higher risk attached to them as well. So for investors, it's a real challenge to try and find that yield, particularly if they're savers, because under the current policies of governments and central banks, it's savers who are being penalised because of the suppression of yields and interest rates. And this is forcing investors to take increased risk in their asset allocation. And that's going to continue for the foreseeable future, especially as growth remains fairly quiescent in most mature economies, and there's little signs of debt levels being reduced substantially as well. The risk is that you get a substantial correction in asset markets, because what we've seen over the last 9 months or so is all assets going up at the same time, which is quite unusual in terms of the history of stock markets. So as well as the equity market having powered ahead by about 30% on average, in some markets a lot more than that, the same is also true in bond markets, and particularly corporate bond markets, which have done very, very well recently. So in summary, I think investors have to keep an eye on how to maximise that yield, but at the same time try to minimise risk, which means more than just diversification, which is traditional in terms of asset allocation, so you don't have all your eggs in one basket. If you need further information, you can contact the Charities Aid Foundation, and one of their representatives will be more than happy to discuss your investment needs.